So hello guys, let's start the day 5 of the video from here. So the founders of the trust bought equal shares of 30 leading companies in 1935 and decreed they could never be sold. The only exception was companies that went bankrupt, merged or spun off. You don't find them making any more funds like this, but back in the early days of the mutual fund industry, most funds looked more like it than not. The first open-ended mutual fund in America and in the world was the Massachusetts Investors Trust, established in 1924, and a site open-ended means you could buy and sell shares of the fund at a price that matched the value of its portfolio. Before MIT came along, funds were closed-end. This meant prices might not match the underlying value of the portfolio. Disclosures were poor, and as you can imagine, sponsors often manipulated prices of their advantage. MIT was something new under the sun. It promised transparency and fairness. It promised low cost professional management for the small investor. It had sensible and conservative investment policy with a focus on large dividend paying stocks. MIT would not trade these stocks but aim to buy and hold. As the late great Professor Louis Lowenstein of Columbia University wrote, the transparency and flexibility and the security and comfort thus offered to small investors made MIT a uniquely American contribution to finance. Good ideas usually have simple beginnings. It is the very simplicity of the concept that makes them ultimately successful. This one was brilliant. Lowenstein told MIT's story well in his book The Investor's Dilemma, which I highly recommend to anyone who invests in mutual funds. Lowenstein is also the author of my two favorite books on corporate finance, Sense and Nonsense in Corporate Finance and What's Wrong with Wall Street. Like Voya, MIT held on to stocks for a long time. In 1949, the average holding period was 27 years. Note, this is an implied holding period based on the fund's turnover. In 1949, the fund was not at 27 years old, and it attracted like-minded investors. Redemptions were less than 3% year. The fee was only 40 basis points, 0.4%. By 1960, the fees would drop to just 19 basis points. But unlike Voya, this tale has a sad ending. MIT's story also illustrates another old truism. Wall Street often turns good ideas into bad ones. It would soon corrupt the simple, brilliant idea of the open ended mutual fund and turn it into another moneymaker for Wall Street. The problem with MIT from Wall Street's perspective is that nobody could make any money of it except the investor in the fund. So somehow somebody convinced MIT to take an external manager in 1969. Before that, MIT had its own managers in house. This was the beginning of the end. With an external manager, the fee started to go up. By 1969, the fee was 36-fold, while assets under management were just 7-fold. The external manager also managed the fund more aggressively and traded more frequently. A sad decline set in by 2004. BlackRock bought the fund and merged it with others. MIT was no more. The typical fund these days charges a lot, the trades way too much, and trails the market badly. Lowenstein wrote in his book that the average fund has 160 stocks and turns them over every year. That's not investing, but Wall Street makes money. The establishment doesn't want you to just sit on carefully chosen stocks. It wants to charge you fees, it wants to sell you stuffs. This brings us back again to Voya Fund. MIT's tale makes it seem all the more incredible. The Voya Fund lasted as long as it has, with its initial mission intact. It's a special fund, a piece of Americana. Okay, so maybe you don't hold stocks for 80 years, and maybe even my coffee can approach with its 10-year holding period is still too long term for you. But there is surely some young person in your life whom you can share the wisdom of long term investing with. Tell them about the coffee can idea, tell them the story of the Voya fund, make them wise to the ways of Wall Street. Regarding these extreme holding periods, a reader wrote to me the following. So my thoughts are that this coffee can is a nice way to leave a legacy for my children and grandchildren. I am 66-year-old and 35-year investments. I know that you consider coffee can 10 years, but it seems to be that the longer you can go, the better it gets. The probably are probably not a good idea now. I was intrigued by the fund that invested in a basket of stocks in 1935 and never touched it again. I am not sure how one would do this now, but it is an approach that saves us from ourselves. The question, how would you go about identifying companies for a 35-year coffee can? When I looked at your list of the best performers, almost all of them were 25-year or greater returns. If I had tried to pick long term investments in 1970, my guess is that I would have invested in stocks like Sears, GE, US Steel, Westinghouse, Exxon, and such members of the Dow. Some would have been okay, such as GE, Exxon, but there would have been no investment in Walmart, Apple, Microsoft, etc., and some would have been bad. Would we better off buying shares of wise investors such as Buffett and sitting on those? The downside is that none of the current wise guys will be around 35 years. The questions raised are difficult to answer, especially now because things change so quickly. For example, take a look at the average lifespan of a firm in the S&P 500 index. It is now less than 20 years. See the chart on the next page. The average lifespan was 60 years in 1958, so things have changed a great deal. At current rate, in InnoSight estimates 75% of the current S&P 500 will be replaced by 2027. Leaving the S&P 500 doesn't mean the death of the firm. But unless there is a buyout, S&P 500 usually kicks you out only when you are in trouble. For example, Circuit City, the New York Times, Kodak, the Bear Stearns are, or they kick you out when you get too small, which is another way of saying you underperformed. Although dropped stocks tend to outperform in the first year after being dropped, excluding those bought out. Average company lifespan on S&P 500 60s. Geez. So yeah, now it's 20 years. I will show you one more chart to make a point. Here is the average asset life of US firms by sector as of 2013. Information 6.6, healthcare 18, consumer discretionary 12.4, consumer staples 15.4, industrial 15.4, telecommunications 16, energy 17, materials 18, utilities 29. This table comes from a report by Michael Mauboussin published in 2014 and titled "A Long Look at Short Termism." Mogosin is an investment strategist and author of several well-regarded books and research papers. He wrote the average asset of he wrote the average asset life of companies in the US is shortening, and more firms are in shorter asset life. Industries must have been concluded. Shorter asset lives suggest shorter time horizons over which managers should invest, a reasonable reflection of the business world. Executives of many technology companies, for example, can't plan for decades in the way a utility company can, because the rate of change is simply too fast. So 35 years is probably too long a horizon to plan over. This creates some tension with 100 beggar ideas. There is a tension between holding on and the potentially destructive effect of time. Nothing lasts forever. We will look at what kinds of companies to focus on in the next chapter. But we are not yet done exploring the coffee can idea. The biggest hurdle to making 100 times your money. This topic I will read in the next video. So guys, if you are thinking my videos are helping you guys and increasing your knowledge, so please subscribe guys, subscribe. Thank you.